What if I told you this trade war could create one of the biggest opportunities in real estate since the 2008 crash? Right now, these tariffs are creating a chain reaction impacting everything from the bond market to interest rates and shaking up the housing economy like we haven't seen in the past decade. So if you're planning to buy a house in 2025, this could cost you thousands, or this could open up a huge opportunity for you. So in this video, I'm going to be breaking down everything what's happening and how to use it into your favor. Now let's get into it. Okay, so here's the overall basics when it comes to tariffs. So a tariff is just a tax that are imposed on imported goods. And it's actually the importer who is the one that's being taxed, which in many cases, those are your big companies. So with the big companies being taxed, what they're gonna do is at the end of the day, they're gonna pass it on to the consumer. And the whole idea is to, number one, make foreign goods more expensive so that will allow the US goods to be more competitive in the eyes of the consumer, which will then increase US production and it'll also increase jobs as well here in the US. And their overall goal is to, one, bring manufacturing back to the US, two, this will increase revenue for the federal government, and three, this will help with the debt crisis, slow the economy, lower inflation, lower interest rates so that then you can refinance all of this debt. But here's the thing, it's actually having an opposite effect. The markets are very volatile, they're not sure how to react, and rates are actually going up. So inflation used to be the direct indicator of knowing where mortgage rates were heading along with the housing market. This is not the case anymore. So if you're planning to buy a house in the next 90 days, you want to make sure that you really watch out for any policy shifts when it comes to tariffs, because this is causing an increase in mortgage rates. Any new announcement comes out. You want to make sure you understand where rates are heading, that even though inflation is decreasing because of this tariff situation and because there's a lot of volatility in the market, rates are actually on the rise. And in this next section, we're going to go exactly why the 10-year Treasury bond is spiking and how traders are pricing in these tariff-driven inflation. In a normal market, lower inflation means lower mortgage rates. And in fact, the last economic data report has shown that inflation has gotten better, but mortgage rates have actually increased. And the reason is they are pricing in and they're reacting to fear of future inflation caused by these tariffs. And a big mistake that I'm seeing home buyers making is thinking that we are in a normal interest rate market and that it's following inflation, and that is not the case. So what you can do is, if you're 30 days out from your closing, go ahead and lock. The likelihood of rates getting better is very slim. If you are out shopping for a home, make sure that you are checking in with your lender and having them run payments on the house that you're wanting to put in and offer in up front, because rates are changing every day, which impacts your actual payment. And also, you can use tools like FedWatch. You can watch mortgage-backed securities for updated information on where rates are headed. And before we get into the next section, which goes over the overall impact this has on the housing market, if you're planning to buy a house in 2025, make sure you hit that subscribe button so you get notified every time I put out a video. So higher rates is going to equal to less buyers in the market. And what we're already seeing now is inventory is already up by 35% from 2024, which means that there are more homes that are sitting on the market. And the main reason is due to buyer affordability that has taken a hit. And what we're seeing in places like Texas and Florida is a lot of buyer demand that has cooled off. And this is not the case across the US. It's really going to depend on your local market. We're seeing in some areas multiple offer situations. So again, it's really dependent on your area. But here's how it looks like. If a rate increases by just 0.5%, that decreases a buyer's buying power by 5%. So if you're able to qualify for a $400,000 house at a 6.5% interest rate, if that rate increases up to 7%, that's going to decrease the buying power to $380,000. Now, there's a lot more that goes into this, but this is just to show how much the rate can affect someone's affordability. So if we're only looking at it through this lens, then yes, home prices will drop. So a big mistake I'm seeing is a lot of buyers and agents are thinking, and they're stuck in the mindset from 2020 to 2022, where they think that there is no negotiating room, that rates are going to continue to go down, and that competition is at an all-high time. But the thing is, you really must understand and know your local market and go beyond that, know the competition of where you're at with your specific price range in order to figure out a good plan moving forward. Because here's where the opportunity is. Whenever we have a high amount of inventory, that gives more leverage for buyers. And you're able to ask for seller credits, you're able to use that money to buy down the interest rate, you're able to get a lot better closing terms. And the thing is, you want to also focus your search on areas that have a high number of days on market. So you want to look for houses that have been sitting on the market rather than homes that just hit the market. The sellers aren't as willing to negotiate, and you won't get as much negotiating power when it comes to that. So with new construction, if building materials increase in price, then they're going to pass that along to the consumer, which yes, will increase the price of the home for the new construction. This is kind of the business model of new construction. At the end of the day, it is a business, so anything is going to be passed along and absorbed by the consumer. It's even happening right now with all the incentives that they give to pay for closing costs, to pay for a lower rate, whatever the case may be, the consumer is paying for it in one way or another. And a big mistake that I see a lot of home buyers making is they assume that new construction is automatically going to be the cheaper and automatically going to be the better option. While they might be the case in certain situations, overall you have to look at all the pros and cons from existing homes, from new construction homes, because a lot of times what they show you in the model home, it's going to be their top of the line, the top of the price with all the bells and whistles, and when you go into the actual design room, the base price jumps up really quickly. So you need to understand the cost of the materials and everything up front, especially if you're buying a home that won't be ready until 6 to 12 months. We're in a climate where we are not sure how these tariffs are going to affect certain things in the future. You also want to make sure that you look at your loan estimate and look at all the fees and compare that to an outside lender, and also compare that same purchase price to a home that's an existing home. And always, at the end of the day, always hire your own inspector. Make sure you have someone on your side that's going behind them to make sure that they are not cutting any corners, especially if things do get more expensive, they might start cutting corners on certain things. So always hire an outside inspector. A lot of people assume that if we start having prices decrease, if home values decrease, or we're having major issues within the economy, that we're gonna see a massive influx of foreclosures. But here's the reality of all mortgages across the US. As of late 2024, almost 73% have a rate of 4.99% or below. And this is the reason why we have a major issue with shortage of inventory, is because people know that if they go buy another house, they cannot get that same interest rate. They cannot get the same affordable payment that they have so far. And even out of these 73%, most of these have a rate actually below 3%. Now, the issue where we're gonna see is those that bought in a higher interest rate market, that bought at the peak of their affordability. And a big mistake that I saw homebuyers making is, number one, they allowed the bank to determine their affordability instead of the other way around, and they didn't price in to their monthly payment increase in property taxes and increase in homeowners insurance as well. Because a lot of times people bought based on future predictions. They automatically assumed that rates would have gone down by now, they could refinance, get a lower payment, and all would be good, and that's not the case. So when you're buying a house, you want to make sure that you know your budget up front. And it's not just the home price. You also want to make sure you understand where you want to be as far as monthly payment, and have that conversation with your lender up front. So here's what you can do now. If you're under contract to buy a home and you're about 30 days out from the closing date, go ahead and lock your interest rate now, because the likelihood of rates getting better, even if they do, won't be significant enough for it to impact your monthly payment. And the risk of it actually getting worse is a lot greater. And a lot of times banks have what's called a float down policy. If the rates get better about 0.25% or more, then you can float it down and get a better interest rate. Now, if you're house shopping, it's really important that before you submit any contract, talk to your lender beforehand. Have them run the numbers and give you approximate monthly payment based on the current interest rate, because rates are changing on a daily basis. And also, you want to ask for, it's a lot of times more beneficial to ask for a seller credit to use that money to buy down the interest rate to get a lot affordable monthly payment than to just lower the price. Now let's go over the math on this. So here's some negotiation tips for this current market, and this only works if there are less buyers out in the market. And here's where the opportunity is. So instead of asking for a price reduction, you can ask for a seller credit. So here's where the math comes into play. So let's say that you negotiate $10,000 off the price of the home, and the price of the home is $400, you negotiate it down to $390. When you are financing, this only lowers your monthly payment about anywhere from $65 to $75 a month, and the reason is you are financing a lot of times for the full 30 years, so that payment is stretched out for a long length of time. But instead, if you keep the price of the home at $400 and you ask them for what's called a seller credit. Let's say you ask them for a $10,000 seller credit and use that money to buy down and get a lower rate. In this case, for this example, let's say you start with this 6.75 and you use that money to buy it down to a 6 flat. Doing this will save you almost $200 a month in your monthly payment, and over the life of the loan, this is going to save you thousands in paying interest. But a lot of mistake that I see home buyers making is they act like a cash buyer and they don't understand that you are financing the full amount, again, a lot of times for a full 30 years. And this is where the opportunity is right now, is when we are turning into a market where there are less buyers, there's less competition, so you're able to negotiate terms like this, whereas if interest rates continue to drop and there are more buyers out in the market, this will not be able to get done because the sellers have more options. So it's important to really understand that right now we are in a politically driven market, and even though inflation is getting better, the market simply doesn't care, and rates are being pulled by the headlines right now and future fear, not the current data. And overall, housing is shifting, but it's not crashing. And if you like this video, then you're going to love the one that I broke down everything you need to know in calculating your debt to income ratio so you don't get denied by the bank.